Hi, I'm Adam Thurgood, Managing Partner of Hightower Las Vegas, and as usual, I'm joined by Rayna who's also now a partner and heads our portfolio management division. And today we thought we would just have a casual conversation, pull up a few charts and graphs, and discuss what's really going on in markets, the big picture themes that we're seeing, the stuff that you might have heard about on CNBC. And the big one that's been going on lately that we've had exposure to, but it's gotten a little crazy, is silver. Silver's had a wild 6 months where it went parabolic, and then it had a horrible 30% down day, where it actually fell more in value in dollar terms in one day than it was worth at the end of 2024. It was $29 or so at the end of 2024 and fell by $30 in a single day at the end of January. So what is going on in silver?
Yeah. When you hear the cryptocurrency conferences, all they were talking about is silver,
Yeah.
things are a little bit different now. And silver is really remarkable because it really has two functions, right? It's a store of value, similar to gold, but it also has an industrial use.
Yeah.
It's used in things like solar panels, in chip production, it's used in batteries, and importantly, the new generation batteries require more silver than they used to. So when we look at these demand projections for silver, which already showed some sort of an imbalance, are now keep being revised higher and higher and higher, which means that everyone needs to secure their supply as quick as possible. Just to amplify that even further, you see nation states trying to secure their silver allocation. So it's been pretty remarkable.
Yeah, it's crazy when you fall $30 in a day when it was more than the value of the asset at the end of 2024, and you're still up 150% over the prior 12 months. I mean, that's just bananas. But silver's also benefiting from gold's performance because it is a precious metal, and gold's had a remarkable run as well. I mean, it's up close to 70-80% over the past 12 to 15 months. We've had a pretty big exposure to gold across all portfolios. We've been trimming that back a little bit. But our bullish thesis for gold started in 2016 when we started to see the tailwinds building for gold. But it really went into overdrive in 2022 when Russia invaded Ukraine, and then the West decided to freeze Russia's central bank reserves, which are essentially bonds, treasuries and other currency, other countries' bonds. And at that point, it became clear to us that central banks would probably start diversifying their foreign currency reserves and buy more gold, and that's exactly what we've seen.
Yes, central banks across the world, really, including Western central banks, some have been buying more than others, but really it's been very consistent since then. And it makes sense. It makes sense for central banks to also have a little bit more diversification when it comes to their foreign reserves, especially when they see the problems that bonds are having when it comes to currency debasement, when it comes to insufficient reward there for taking that risk on taking a bond of a different country when it comes to currencies, for example. So it only makes sense that they would want something that's more neutral, that they would have access to no matter what.
Yeah, and that central bank tailwind is probably going to stay in place for a while. It's not like we're in a geopolitical calm period. Every day there's something wacky going on, and it appears to be ramping up in both frequency and amplitude. So I expect central banks to continue to buy gold. Maybe they slow down their purchases a bit, but right now they're taking roughly a quarter of the supply off the market, and that leaves just jewelry demand and speculative or investor assets or investor purchases with a lot less supply to go after.
Yeah, but even if we think about, okay, what if they completely stop buying gold? I mean, it's not like they're going to start selling gold. They're not speculators. Even if gold prices were to decline 30%, 50%, it's very unlikely for central banks to start selling all of a sudden what they just bought.
Yeah.
So I think that really adds a structural support there for gold prices in the long term. But that doesn't mean that gold is cheap.
Yeah, well, we look at gold in all sorts of different ways when we're thinking about it in portfolios. We view it mainly as a hedge. Bonds and gold have different properties, and they have different value to portfolios based on some of the underlying dynamics that are going on in the marketplace. And so one of the ways we look at it is through debasement and yield curves. And if you look at the chart here, what we're going to see is the gold, the best case environment for gold is at the bottom right hand corner when all countries are debasing their currency, which is a fancy word for saying they're out of control either with fiscal spending or money printing, and when yield curves are flat, which means that you're not being compensated to buy longer term bonds because they're giving you roughly the same yield as a shorter term bond. Now, over the past 18 months, we've seen the gold price, this metric be right on top of that yellow star in the bottom right-hand corner where gold was the preferable asset. But over the past 6 months or so, more currencies or countries have seen their bond market yields steepen. So gold's no longer in that perfect nirvana state. It's moved away from that point a bit, but we're still closer to being in a preferable environment for gold relative to bonds, which would be in the top left corner when all countries are protecting their currency and the yield curve across the globe, yield curves across the globe are really steep. So we do have a little bit less love for gold today than we did 12 to 18 months ago, but it's still the preferred hedge in a lot of portfolios.
Yeah, it's no longer the slam dunk it used to be for multiple reasons, but it still has a place in the portfolio. And also when you look at the price dynamics, we should pay attention to that after all. When you look at gold compared to the S&P, for example, once one outperforms the other, that tends to be a long-lasting trend. And currently the trend is in gold's favor. So we should definitely give it time for this to develop, to see once it reverses, perhaps that's when it's the time to really take gold off the portfolios completely. But for the time being, it seems like it still has tailwinds when it comes to when it comes to stocks. Also, when you compare gold though to other things like gold compared to home prices or to disposable income, or gold compared to a barrel of oil, I mean, it's not cheap by any measure.
Yeah, I mean, gold is there to protect purchasing power, and at times you gain purchasing power by owning gold. And we could be at a point where it makes more sense to have a little bit more of other assets, like maybe more energy, for example, relative to gold. But we still think that gold plays an important role in portfolios. Now, the S&P has been underperforming gold for the past year, actually the past 20 years. But it's also starting to now underperform international markets, which is kind of a new phenomenon.
Yeah, in the last year, really, the outperformance of international markets has been pretty significant, going up more than 30% compared to still healthy returns for U.S. stocks at 14%. But when we zoom out and we look at, for example, the last 5 years, that divergence has been pretty stark. Really, U.S. assets have been the only game in town, and technology companies have been very dominant. And we have room to go if we want to converge the two. We have, I mean, that's a 47% divergence, and it makes sense for it to correct at some point. When you look at the dollar, for example, that's an important component of that. And the fact that international investors have a really large overweight still in U.S. assets. So for an international investor, really, what are the sources of their return? I mean, are the assets you're investing in going up in price? And is the currency also going up in price, and to what extent, or down? Yeah. So when the dollar is declining, and in the last year it has declined by about 10%, there is an incentive there for those international investors to start locking in some profits.
Yeah, and taking it back home. Our model is pointing to the dollar to continue to weaken over the next year by another 10% or so. I mean, the model's not perfect. It's going to bounce around the model's output forecast range, but what we've seen over time is that it does tend to reconnect with that level. And maybe we don't go down 10% over the next year, but if the dollar doesn't go down, it would be a surprise to us. At least it would be a bigger surprise to us if the dollar went up a lot over the next year. But we do think that the dollar can continue to weaken, which is usually good for global growth. Because the dollar is so heavily used in trade, when it goes down in price, it tends to relieve some pressures in the world a lot of countries borrow in dollars, and when the dollar goes down in price relative to those currencies that the bonds were issued in, that helps to offset some of those pressures. And that means usually that global growth picks up and cyclical assets tend to start to outperform, which is what we're seeing today.
Yeah, commodities are priced in gold after all, in
dollars.
dollars.
Yeah.
After all, so of course that would be a little bit of a stimulus for the world when the dollar starts to weaken a little bit.
Yeah.
But then the imbalances correcting right now are not only in precious metals or international stocks, but when it comes to the equal weight index versus the market cap index, right? The equal weight index is where you see each company, a constituent of the index, given the same share of the index compared to the market cap, where the largest company gets the largest share. And the two have really diverged in an extreme manner over the last few years, and that has started to correct itself now, with the equal weight index starting to outperform the market cap index. And we think that that again has room to go if it was to completely mean revert. And historically they have traded in tandem.
So what usually causes that outperformance of equal weight to continue?
Well, I think it makes sense when you look at also what's going on currently out there in markets. You have the mega cap names that were really the only game in town for a long time. They were cash printing machines, asset light models with high margins, just creating so much free cash flow for years and years. And now that's completely being transformed. They're having to invest vast amounts of cash to build out that AI infrastructure. And the rest of the economy is a direct beneficiary of that. So that cash is finally being put to use in the real economy, adding fuel to the fire when it comes to the equal weight outperforming. And then you also have the government supporting the economy overall. When you look at our spending and
it's pretty remarkable that we're running 6% plus deficits as a percent of GDP when we're not in a recession and we're not really involved in a major conflict. I mean, there are conflicts going on in the world, but it's not like a world war. That's an enormous amount of, I guess you could call it an indirect subsidy that's being pumped into the economy. If GDP growth is 2.5% a year and we're running a 6% budget deficit, if the government came out tomorrow and said, "Oh, we're going to balance the budget and that's going to zero," like we would be in a ridiculously large recession. It's never going to happen. But the fact of the matter is that there's a lot of stimulus naturally in the marketplace already because of government spending. But in order for growth to go up, that stimulus has to increase even more.
yes. I don't think it's so indirect when it comes to the subsidies going on. I mean, when you look at the provisions in the One Big Beautiful Bill Act, they're pretty direct and pretty stimulative. You have things like full bonus depreciation, which helps that infrastructure spending we were just talking about. We have full R&D expensing, which should help theoretically innovation. And we have some other provisions that are designed to support small and middle-sized businesses. So I think the government is very deliberately trying to stimulate the economy to its full potential and perhaps a little bit beyond that, or to transform it in a way. But that is something that is really helping those smaller companies out there catch up to the leaders, the previous laggards becoming the leaders now, the market being broader, which is a good thing.
Yeah, and if the government is successful in stimulating the economy, there's a chance that inflation could ramp up because we're not yet back to where we really should be on an inflationary front, but we'll leave that conversation for another day. When we look at the growth in global GDP, when we look at all this spending that's requiring real assets, when we look at the energy that's necessary to power all this stuff, that's where some disconnects start to occur. If you look at the S&P 500 main players, they're technology companies, and then they're technology adjacent companies like Amazon, which is a discretionary, or Google, which is a communication services company. They represent a massive portion of the index, and they're huge energy consumers, whereas the whole energy sector is worth less than half of NVIDIA's share in the index. That's an internal inconsistency that we didn't think could last. And it appears the market's sort of waking up to that reality because energy shares have done quite well over the past few months.
Yes, and that's a story really across commodity markets too. That infrastructure spending we're talking about, that geopolitical strife we're talking about with countries trying to secure supplies for their supply chains, procurements, those are shifts out there that are reverberating through markets and impacting commodity markets in a big way. And all of these have a very small share of the index.
Yeah.
So it's getting very interesting out there.
Yeah, if people start to rotate just a little bit out of their tech names and buy something like energy or some materials that don't have a lot of liquidity, those prices can go up pretty quickly and in pretty high magnitude.
Yeah, so what are the biggest takeaways from today? I think we should really summarize this up a little bit.
Well, have at it.
Well, I think one of the biggest takeaways here is that we do have a shift to real assets. We do have some imbalances finally starting to correct themselves. Of course, nothing moves in a straight line out there in markets. And then growth is really key. Are CEOs going to really spend that money that the government is incentivizing them to spend? Are they going to build all these factories despite all the uncertainty out there? That remains to be seen. Of course, nothing is ever rosy out there. There's always things to be looking out for, and we should always pay attention and watch like a hawk what's going on out there and be ready to shift things around. But we feel pretty confident that the way that we're positioned should benefit us in the long term.
Yeah, and we'll keep an eye on it because markets are moving quickly. There's a lot of weird stuff going on, but it does appear to be moving in the direction that towards real things rather than just a few tech names. But we'll have to keep an eye on that and make sure that it continues to play out. Anything else you want to leave the audience with today?
No. As always, thank you for your time, and let us know if you have any questions. Don't hesitate to reach out, and have a great day.
Take care.